The financial system is breaking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, there is mass panic by the banks as they borrow a record amount of money from the Federal Reserve as the liquidity crisis deepens. And this is putting into serious question of what is actually going on in the financial system, because we're having what is considered a crisis level response at a time when we're being told that there's nothing wrong with the economy, that everything's okay, that inflation is the issue and the Fed is going to contain it, and next thing you know, a massive hole starts to open up in the financial system, and it starts to make you wonder. And the question we're going to attempt to address in today's show is, do the banks actually know what's going on? Does the Fed know what's going on? Do the policymakers know what's going on? Is this a problem that they are aware of and they're just trying to get it back into containment before it goes awry, to say, look, we took care of this, it wasn't a big deal, see, everything's okay? Or are all of them responding to an issue that is far deeper and far more severe than any of us want to recognize? Well, let's head over to Bloomberg. Let's go back now to late yesterday and pick this story up and see if we can figure out the truth of what's going on in the financial system before it implodes. How First Republic Bank received a $30 billion lifeline. So this posted after the show aired yesterday, as 11 banks stepped in to deposit $30 billion to backstop the distressed firm, which of course is putting into question, what kind of bailout is this and will it even work? Because why are they doing this? Why would the big banks want to turn around and put money into these smaller and mid-sized banks? Well, one of the key things is, due to all the banking regulations, the big banks are highly constrained on what they can do. The last thing they want to do, and I know many people believe this, the big banks want to swallow up these smaller banks. The answer is they don't. If they wanted to, they could just go buy them. But where do a lot of new loans originate from? It's not from the big banks. It's from the small, mid-sized, the community banks, credit unions. That's where it comes from. They're the powerhouses, and of course, at the lending side of this, and the big banks need these smaller banks to stay around. And all month, the nation's banking giants have been raking in deposits from nervous customers of smaller firms, which is only going to lead to more attention to the big banks. And now they're taking some of their own money, quote unquote, own money, if you believe that, and handing it back to that San Francisco bank in distress. And of course, this makes sense, because if it works, it's brilliant in a sense, because now the big banks, they're already under fire for soaking up these deposits, which again, as we've made a case on the show, that is all due to the Federal Reserve. So the Federal Reserve did their overnight repurchase agreements to back money markets and said, look, we're going to give everybody this real attractive rate. Meanwhile, a lot of these small and mid-sized banks had to buy all these low-yielding assets, these treasury securities and over the government securities during the pandemic. They're locked into them for right now. They can't get out. Customers saying, you owe us more interest, and the banks are saying, we can't pay. We can't get rid of these assets. We're upside down. So again, the problem here stems from the Federal Reserve raising rates and then giving everybody the opportunity to get a piece of it through the money markets. So of course, this puts the big banks under fire. And now, of course, they can show they're part of the solution, because the biggest fear, if you want to know what the biggest fear for the big banks are, is getting caught up in another crisis. They got caught up in the global financial crisis. They didn't like it. Although we can blame them, and that is fine, they didn't want to be in that position, because you know what happens if they get caught up in another crisis? Congress this time isn't going to put up with it. They're going to seek to split up the big banks and their powerhouses, and I can tell you the executives there don't want that at all. But does this mean this will work? Well, it's not guaranteed to work, and there are already signs, as we're seeing in early trading today, that this market does not buy this. Their strains in the financial system have yet to abate, which again comes back to the original question we started the show is, what is actually going on here? Because nobody seems to be stepping up and saying, hey, I have an answer, and this is a solution. So far, we heard from President Biden said we're going to backstop all deposits, which we're now starting to find out, well, maybe that's not entirely the case. We heard the Fed stepping in. We're seeing banks trying to bail out other banks, and we're wondering what is going on, because they're acting as if nobody has a clue of what the real problem is. And now let's take a look at the response, because this is crisis level stuff we're seeing at a time that we're not actually in the deep part of a recession, which gets you to start to wonder is, if this is how bad it is now, How bad is it going to get? Here we can see from Zero Hedge, the Fed balance sheet deposits, what they call a Hotel California. It says no surprise why banks borrowed, get this, a record $152 billion from the discount window. They only borrowed $11.9 billion from the Fed's new bank term lending program. Of course, this is a question is, why aren't people borrowing from the Fed's new program? Is it a stigma that, hey, you don't want to be a part of that new deal? Are the terms just not favorable? Well, again, it's coming back to what is the real issue here. So for those of you who aren't familiar with the discount window and why this is such an issue, let's take a look. Let's head over to the Federal Reserve website, where we learn that the Federal Reserve lending to depository institutions, aka the discount window, plays an important role in supporting the liquidity and stability of the banking system and the effective implementation of monetary policy by providing ready access to funding. So here we go, because what this does is it helps depository institutions, which is where the problem's at, manage their liquidity risk efficiently and avoid actions that have negative consequences for their customers. So what should we see right now from this is we should see the whole thing start to smooth out. We should see the liquidity option problems start to go away. And instead, what are we actually seeing? The problems are getting worse. But to put this in context of just how much money the banks have borrowed from the Fed now, here you can see the global financial crisis. This was the response in the midst of this. Here was the pandemic. Here is now. So the question is, why is this so bad? Because when you see that chart, it almost takes your breath away and wondering, what do they know that we don't know? Or what do they don't know because they don't know what the actual problem is? So they're literally throwing every solution at it, hoping whatever it is goes away, because if it doesn't go away, well, it's only going to get worse and far worse. So now let's take a look at how the consumers are handling this, because what we're seeing from depositors is they're making the problem even worse. And for that, we head over to Schwab, with this headline from Bloomberg, as Schwab clients shift from prime funds to government portfolios. Now, you might say, well, who cares? What's the big deal? Why would that matter? Well, here, let's take a look. As Schwab saw $8.8 billion of net outflows from his prime money market funds this week, as investors riled by turmoil at U.S. banks plowed even more money into the brokerage's other portfolio that favor assets. Well, suddenly, with government backing, now remember, not long ago, no one wanted anything to do with U.S. treasuries or anything government related, but now all of a sudden, everyone's running to Big Daddy Fed and the government to say, hell, help me out. The Schwab funds are among the largest prime money funds in the U.S., a product that is typically invested, get this, in securities issued by financial institutions and non-financial companies. So what would be a financial institution? Well, you can gather that would be a bank. Prime funds are a source of capital for many of the world's largest financial institutions, and Schwab funds held certificates of deposit from Deutsche Bank, Truist Bank, as well as commercial paper by units from Citigroup and Bank of America. Of course, the question that this is going to leave a lot of people with, and maybe why they're moving their money out of these funds, is what other exposure do these money market funds have that are not sitting backed by the Fed, that are not backed by government debt? They may have exposure to these other regional banks, maybe not a lot of it, but maybe enough of it to cause some severe problems. So again, now all of a sudden we see, of course, banks trying to solve other banks' problems. We see depositors only making this worse by saying, you know what, I'm going to pull my money from here and move it over there, which is yanking this key source of liquidity out of the banking system. And yet, what do we hear, of course, from our Treasury Secretary, the former Fed Chair, Janet Yellen? Of course, you may remember, she said she'd never see another crisis in her lifetime. Well, Janet, you might be getting it right now. If Janet Yellen says banking system is healthy after Silicon Valley Bank collapse, well, I think we're going to put that into question right now, as Ms. Yellen in her opening remarks pushed back on the idea that the government steps, which also included a new Federal Reserve facility to lend money to banks to meet withdrawal requests, represented a bailout. She said shareholders and debt holders are not being protected by the government. Importantly, no taxpayer money is being used or put at risk in this action. And that both of those are correct. This is why you're seeing the stock price of these regional banks continue to collapse, because there's absolutely no confidence. People are uncertain of what's going on in the system. All they're seeing is everybody's throwing solutions at the wall. None of them are sticking. The government saying, look, we're not going to bail you out if you're a shareholder or a bondholder. And what that means is you got to get out because you don't know if this situation is going to only get worse. Now, from the Fed's perspective of what Ms. Yellen is telling us here is the Fed isn't printing money. They're doing an asset swap. They're just taking securities and they're lending money out to the banks and for a short term. So that's fine as well. So again, there's no taxpayer bailout here at all. But the question now comes to be, remember, they said everybody was guaranteed, had their deposits guaranteed. Well, now we're finding out that may not be true at all. As Treasury Secretary Yellen says not all uninsured deposits will be protected in future bank failures, this going against what we heard from President Biden just a week ago. As our banking system remains sound and Americans can feel confident that their deposits will be there when they need them. I don't know, what do you think about that? Are you confident in the banking system right now? Are you confident that you're going to be able to park your money there and not worry about it? Leave some notes in the comments. I'd love to know what you have to say, because Yellen now, under oath, has admitted that not all depositors will be protected over the FDIC insurance limits of $250,000 per account, as they did for customers of the two failed banks. Of course, then now you start to wonder is, who is going to be protected, who is not? Of course, that's going to only put more doubt in depositors' mind. And guess what it's going to lead to? Further outflows of those banking systems and a further problem with this liquidity crisis that is going to only get worse. But yet, despite all of this, what are we hearing? We're being told again that central bankers should not worry about the banking problem because, well, there really is no problem. Inflation's the real issue here, and we still haven't gotten into the even severe problems in the financial system. Let's get to this shortly, because I want to set up the fact that the next week we're likely to hear the Fed is going to raise rates on Wednesday and is going to have to answer a whole lot of questions from the press. Central banks should press ahead with rate rises despite bank pains, says OECD. This from the Wall Street Journal, as the chief economist cautioned against a pause, saying the central banks should stay focused on bringing inflation rates back down to their targets despite worries about the strength of a global financial system. We still think that knowing what we know, which I'm questioning, is what do they actually know, that the priority is fighting inflation. We don't see systemic risk here because, look, I tell you what, you want to have a big deflationary crash, you want to see the economy come down to its knees, all you need to do is have a banking crisis and it will solve everything. But here you see from another policymaker, hey, we don't see a problem here. Whatever's going on with the banking system is probably just isolated. It's not systemic. And by the way, inflation becomes the real issue. And yet now what we're seeing is internally to the problems of the financial system are far worse than we thought. Now let's head back to the Wall Street Journal, because this will shock you. Market stress snarls trading in U.S. Treasuries, something well, shouldn't happen at all. And liquidity, the capacity to trade quickly at quoted prices, has fallen sharply in the two keystone markets, those for U.S. Treasuries and German bonds. Difficulties include wider price spreads, and slower executions are now spreading to many other markets, including those for derivatives that firm and traders use to lock in prices and hedge risk weeks and months ahead of time, such as options, futures, and swaps. So here we see that a system that is designed to provide liquidity is starting to seize up. This is not supposed to happen, particularly not, again, in a time where we're to believe that there's nothing wrong with the economy at all. And yet the ICE B of A Move Index, a measure of volatility in the bond market, rose to the highest level in 3 years. So it's saying, look, the bond market is saying there's stress, there's problems here, and this surpassed the records seen during the March 2020 crash. And of course, as we dig deeper, Zero Hedge addresses how bad is it really? Well, as Wall Street Journal said that, of course, trading was strained, they warned that continuing treasury market dysfunction could add a new element of stress to markets already reeling from the threat of inflation, as U.S. bank failures and fears that big lenders in Europe could also come under pressure. A trade that should take seconds took minutes. So now the question you're maybe saying is, Does this mean there's a problem with the U.S. Treasury market? Well, perhaps it means just the opposite. Perhaps there's such a demand for collateral and pristine government bonds that people are not willing to trade them because they're not sure of what's going on and they might need to keep what they have. And now you're starting to see the system seize up. But it's not just that. As Zero Hedge continues, there's more. It wasn't just bond liquidity that cratered. Earlier this morning, both the Fed funds, this is back to Wednesday, and SOFR futures, the instruments which directly transmit the Fed's monetary policy into the broader market, were halted as daily price band limits appeared to be reached. The June 2023 SOFR future contracts appeared to halt trading around 9:14 a.m. New York before resuming a whopping 2 minutes later, which to you may not sound much time, but in a trading world, it might as well be infinity. At the same time, the August Fed funds futures also appeared to halt trading for a 2-minute period. And he says here, Edward Bolingbroke, nothing to see here, just a circuit breaker triggered in June SOFR futures this morning, something that again should never happen. So what the question we started the show with, do the policymakers, does the Fed, do the big banks know what's going on? And I believe the answer is they don't. And that's what scares me, is we're facing something that is not just a surface level problem. There's a far deeper crisis here. And perhaps in a matter of days or weeks, we will find out. And unless some of this solution, the problem that they're trying to fix, some of this actually works and puts this thing off down the road. But I'm afraid it may not happen. And if that's the case, well, get ready. Something much worse is coming. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.